It was the worst first 4 months of the year for the stock market since the 1970s. No, not the 70s, the 1930s. Can't we just say it was a really bad start to the year? Bad might do it an injustice. After dropping 3.3% this past week, the S&P 500 index has fallen 13% during the first 4 months of the year, the worst start since 1939. The NASDAQ tumbled 3.9% during the week, putting it down 17% for the first 4 months of the year. That is the worst start to a year since the beginning of the NASDAQ in 1971. I'm Ben Ripond. Today is May 3rd, 2022. I want to give you a context for my broadcast. I'm an independent investment advisor, and I do completely independent research. I operate under a Series 65 fiduciary license and am beholden to no one except my clients. My goals in broadcasts are to remove any bias that I might have about the future direction of the stock market. 2, to stay true to my goals of independent research. 3, present material that you're not likely to get elsewhere, and present it so that it is helpful to the average investor. Links to outside sources are in the comment section below. I do not allow any ads, but would appreciate it if you would like, share, and subscribe to my channel. In today's video, I will cover both bubbles, the stock market and the bond market, trouble for buy and hold portfolios, shipping issues all over the world, the direction of the stock market from all perspectives, and what you can do to protect yourself. As I cover information that I've uncovered with my research, I know that quite a bit of it is negative. And sometimes we can take that in and be discouraged about it. So I thought I would begin by covering the things that are positive so that we can see this in a balanced perspective. Both the positive things that we can look at and those that are of concern that we need to pay attention to. And then once we understand those, then I'll cover what we can do about it as best I can. So let's look at what's positive. Now think about this. Some of these you'll relate to, maybe not all of them, but think about what's positive in your life because that counts. If you have a job, that's positive. If you're in retirement and have a source of income, that's positive. If you have an investment account, that's positive. If you have enough to eat every day, that's positive. There are actually 810 million people who are starving right now, starving, and don't have enough food to eat. That's almost 1 billion. So if we have enough food to eat, that's very positive. If you're in reasonably good health, that's positive. That's not a guarantee. If you're a person of faith and believe that God is your source of strength, that's positive. If you love your family, that is positive. If they love you, that is positive. If they love each other, that is positive. And as you know, in life, none of those are guarantees. If your home is paid for, that is positive. If your home is not paid for, but has a lot of equity and a low interest mortgage, that is positive. So you see, there's a lot of things that we can see in our lives that are positive. So while I'm going to present, I'm going to jump right into it, things that are of great concern. There are things we can do about those things, but let's balance them with the positive and then the things that are of concern. As I covered in my introduction, according to Market Watch and Bloomberg, Forbes, others, there's information. The S&P 500 has had its worst start since 1939 for 4 months. The worst 4 months, even including 2008, the worst first 4 months of the year. That's of concern. We don't know if that's going to keep on going down. If so, how far? We're right at that breaking point, and the economist, Mr. Hartnett for Bank of America, said that the support level for the S&P 500 is 4,000. It closed on Friday at 4133. And his comment was, he said, if it breaks below 4,000, there's going to be a mass selling of equities. We're 133 points away from that happening. So there is, we're not that far away from a big sell-off in equities. We don't know. It may go up from here. We don't know. But looking back on the last 4 months, absolutely, this was not planned for by most people. What's worse than the stock market is the bond market. So this is considered the worst bond market in history. Now, when I saw those headlines, I don't know if that means U.S. history or how far back in history, but wow, the worst bond market in history. This is of much greater concern than the stock market, in my opinion. On January 17th, I covered an article that was in Seeking Alpha, and the article said, forget a stock market crash, the bond market may collapse first. Sell TLT, and TLT is the exchange traded fund for the long-term government bond. A lot of people, a lot of financial advisors use that as a corresponding antidote to equity risk or something similar to TLT. January 17th. So here we are today, May 3rd, about, 3 months later. The bond market has continued to collapse, and I mean it has collapsed. It is down about 19, 20% since the first of the year. Worse than the NASDAQ 100, worse than the S&P 500, worse than the Dow, at a time when it used to be that when stocks would go down, well, bonds would tend to go up most of the time. And that was a counterbalance for equity risk. However, now we've entered this new paradigm, and the new paradigm is rising interest rates, putting a damper on stocks, and of course bonds go the opposite way from interest rates and bond yields. So the traditional portfolios, the traditional advisor, there's trouble. And if you're in a traditional portfolio with a traditional advisor, 60-40, buy and hold, whatever you want to call it, if you're paying attention to it, you know that you're down a lot. And there is not any answer. Financial advisors, in my opinion, from what I'm being told, are giving sound bites as far as solutions. They're not selling anything. They're not changing the asset allocation. They're just letting people sink. And bonds, when they should be going up, are worse than stocks. This is a horrible picture for the average investor and the traditional portfolio. In August of 2017, Alan Greenspan, former Fed chairman, said that there's trouble in bonds, that there is a bubble forming in bonds. I read this from Jim Rogers and from Scott Minerd and David McIlvaney, others who were saying the same thing. But when the former Fed Chairman Alan Greenspan says it, I would take note. And so Market Watch, it makes me wonder if they're beholden, I think they are, beholden to the financial industry and the financial advisors. So they put out an opinion piece that said, why Greenspan is wrong about bubbles in bonds. Well, guess what? Greenspan was not wrong. Greenspan was ahead of his time, and he was right to sound the warning signal about bonds. And Market Watch was wrong. 6 months later, in February 2018, I covered this. I was doing webinars at the time, and so if you attended one of those webinars, you know this. Alan Greenspan says there are two bubbles. Okay, so 6 months before he said there's a bubble in bonds. Now he's saying there's two bubbles. There's a bubble in stocks and there's a bubble in bonds, meaning something is about to burst. He was exactly correct. Exactly correct. He was 4 years ahead of this happening, 3.5 to 4 years. But boy, has it happened exactly as he predicted. A bubble is bursting in stocks and bonds. I want to play a piece for you from Steve Forbes. It's a couple of minutes. It's very interesting, and it makes the point that have just been talking about.
Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. Individual investors should stay out of bonds. If you have them in your portfolio, either bail out or make sure the maturities are no longer than 3 years. Now, some institutional investors, such as insurance companies, have to purchase bonds for regulatory purposes, but not individuals. Because the great bull market in bonds that began in the summer of 1982 is over. Treading water is the best that bondholders can hope for now. Until recent months, bonds have been a positive investment, but that is changing. Interest rates on treasuries have gone up from where they were in 2020. That's a sign of trouble to come. But because rates are still extremely low by historic standards, many investors have been reaching for yield by buying bonds of less than stellar companies. The yields they're getting on this paper, however, are way too low considering the risks they are taking. When the economy slows next year as the sugar high from all that government spending wears off, many of those shaky companies will falter, and the bonds they issued will default, as those corporations either restructure or are liquidated. Even the yields investors get on bonds issued by the federal government are miserable considering the likelihood that we'll be experiencing more inflation, thanks to the possibility of even greater spending by Uncle Sam. We have never seen anything like this prospect of spending and ever more increases in the national debt during peacetime. Eventually, even the mighty Fed will not be able to suppress interest rates. Reality will set in. Rising interest rates mean, by definition, lower bond prices and losses for investors who hold them.
Then we get to the great entertainer, Jim Cramer. And Jim Cramer knows a lot about the stock market. He knows a lot about stocks, and he's a financial guy. But above everything else, he's an entertainer. So if you watch him, I hope you're watching him just for comedy's sake, just for entertainment's sake, because his advice has consistently been horrible and has actually been very wrong. In 1999, where he made his name when he founded TheStreet.com, and he was, pumping internet stocks, .com stocks in the late 90s, pumping them and saying they're going to go to the moon, we've entered a new paradigm, and Warren Buffett was saying, not so quick, I don't think so. The price earnings matters, and revenues matter. And no, Jim Cramer was on the bandwagon pumping stocks. These stocks lost, most of them lost at least 90% of their value, and many of them went out of business. Jim Cramer's reputation sank, but he learned that he's an entertainer. So CNBC, I don't know why they put up with this, but they have him on their show, and he does, I guess they get a lot of ad revenue. But last year he made a prediction. He called it the Magnificent Seven. These were his winners that were going to go to the moon. Well, it brings me back to Jim Cramer being a horrible forecaster. It took me back to what I heard him say in 1999. So he predicted the best 7 stocks you could own: Peloton, Zoom, Roku, Netflix, PayPal, Square, Tesla. 7. They are down since last year. Peloton down 85%, Zoom down 81%, Roku down 62%, Netflix down 61%, PayPal down 58%, Square down 44%, and Tesla down 7%. That's his Magnificent Seven. So I'm just saying, I'm not trying to bash Jim Cramer. Just don't take your financial advice from him. Use him as a person that you can, for comedy's sake and for entertainment. He is that. Back to bonds. The Vanguard Total Bond Market ETF. This is a chart going back to 2010. So it shows you the up and down motion of the bond ETF and where it is today. The big run up occurred from 2018, 2019, all the way up to about mid 2020. And then it began to collapse, and you can see where it has gone. And so while it has gone down, this is just a bond index. It cuts across a variety of bond types. The interest rates have gone up, and bond prices have come down, and they have come down sharply. The last part of this, you can see, is the sharpest move down, which is mostly this year, but quite a bit of it since mid 2021. Now, the 2-year government bond yield, the 20-year, the 10-year, the 5-year, the 2-year, they've all gone up a lot. What percentage-wise has gone up the most has been the 2-year, which has caused this problem with what's called the inverted yield curve, with the 10-year bond having a lower yield than the 2-year bond, because the 2-year bond has shot up so high. So people want to hold their hold bonds, but only for a short period of time. They want the short maturities, not the long maturities. As a result, this has become consistently an indicator for a coming recession. But this just shows you the magnitude of the increase of the 2-year bond since mid-2021. And that's when bonds and bond funds have begun their collapse. So if you took this chart and inverted it so that the end of the chart wasn't pointing up but pointing down, you would get a sense for the direction that bonds are going. And it's not true of just the 2-year, but 5-year, 10-year, 20-year, and corporate bonds, all having lots of trouble. Then you get over into 401k plans. I thought I would cover this because a number of people are covered under 401k plans or 403b plans, and the popular funds, Fidelity and Vanguard being most of them, they've also had their trouble. And this is a chart that shows those. This takes the S&P 500 is down about 13% for the year. When you look at that yield, that return, and convert it to an inflation-adjusted return and compare it over previous time periods, inflation-adjusted, The market is not down 13, it's down 40% on an inflation-adjusted basis. And this says the worst since Nixon. Well, I don't know what Nixon had to do with it, but if you go back into 1973, 74, that was a big bear market that went down. The stock market went down, I believe, 48% during that period of time. It was not a good time. And but similar to that, here we are today if we adjusted for inflation. The S&P 500 has 11 sectors. All the various types of industries in the economy, there are 11 of them. And the blue bar in the center is the S&P 500. So you can see the amount of loss. I've already told you it's about 13%, the amount of loss of the S&P. The sectors, they're all down except for one on the very end. Consumer staples is actually up a little bit over 2%. But they all go down, some more than others, some less. And the ones that are down the worst on the far left of the chart are communication services. That would be like telecommunication, consumer discretionary, technology, and financials. If we were to put biotech in here, I think it would be the worst. But that's not it's more of a sub sector than a complete sector, but it's down a lot. This shows the biotech sector being down since its top at the beginning of 2021. It had shot up from the March low in 2020 up to through 2020 up to early 2021, and then it began a rapid decline, and it has come down 55%, the biotech sector. Bloomberg put out a piece on this. I thought it was interesting. This kind of foretells, it's not official. This is just a story, but it's an interesting story. And I think it foretells a little bit of the coming housing market. This guy's name is Mark Kiesel, and he is a portfolio manager at PIMCO. And they did the story because it is reported that he sold his house in 2006. I'll read you just a piece from Bloomberg to tell you what the story behind this is. The title says, "Investor who called housing top and bottom says it's time to sell." The article goes like this. Bond manager Mark Kiesel sold his home in 2006 when he predicted the housing bubble would pop. He bought again in 2012 after U.S. prices fell more than 30% and found a floor. Now, after a record surge in prices, Kiesel says the time to sell is once again at hand. Sky-high values and soaring interest rates dampen prospects for future appreciation, according to Kiesel. He's considering putting his house on the market and becoming a renter rather than an owner. And he says this, "I can look to my long-term 25-year charts and they tell me when to buy and sell, and they're flashing orange right now," Kiesel said. "I think we're in the final innings." And I put this chart up. This was part of the article. This is from the Case-Shiller Housing Index. And you can see these periods of time mark the time when he sold his home, when he bought another home, and today when he is considering selling his current home. A week or two ago, I covered the shipping congestion in the Chinese ports, actually 5 Chinese ports. And at that time, there were 477 ships. These are big container cargo ships waiting out in the harbors, waiting to get in to unload their cargo. 477. So then I saw this on Twitter. They zeroed in on the Shanghai harbor, which is the largest harbor in the world. So you could see you couldn't see it when you looked at all five, but when you looked at just Shanghai, you can see the magnitude of ships that are waiting out in the harbor, waiting to go in. It's a satellite view, waiting to go in to unload. And you know how big these giant cargo ships are. That's a lot of cargo. Then, this is from Scott Gottlieb. He had another post I thought was fascinating. I thought I'd share it with you. This shows the worldwide shipping traffic. Now, this is all of the shipping traffic from a macro view for the whole world, but there is concentration and congestion at major ports all over the world, probably Shanghai being the worst or among the worst. But that's an interesting view to see how much shipping traffic is occurring worldwide. I'm going to jump over to the stock market, go through, and bond market, go through some indicators and some indexes and so forth, kind of pointing out the direction of the market. Now, these are all lagging, it's lagging data, lagging indicators. They're not a forecast necessarily of what's going to happen, but they certainly tell of the current condition of the market. The first is major indexes, the performance of major indexes, including some sectors and bonds. So the top two, the Dow and the S&P. This is as of Friday. The Dow is down 7.6, S&P down 11.8. TLT, the long-term government bond, down 19, and as I'm broadcasting this right now, it's down again today, probably pushing it to negative territory of 20% or more. QQQ, the NASDAQ 100, down 19%. The NASDAQ 100 technology sectors, this technology sector within the NASDAQ 100 is down about 24%, and the ARK Innovation ETF, ARKK, which is the Innovator Fund, down 48% since January 1. This covers the all equity indexes. There are four in the US, the Dow, the S&P, NASDAQ, and the Russell 2000, and two foreign indexes, the emerging markets and the developed markets. The best of those is the Dow. It's the best of the worst. They're all down. And the worst of the worst is the NASDAQ 100. The others are in between. On the right side, on this dashboard, I show where these indexes are relative to their 20-day, 50-day, 100-day, and 200-day moving averages. So this is an indicator when things start to go negative and drop below a moving average, these being four major moving averages, when it starts to, that generally starts to spell trouble. When it drops below two moving averages, even more trouble. So when it's below all four, this is not a time to buy. And it was long ago, time to sell. Not necessarily now, but 24 out of 24 below their moving averages. Not a single one is above any of those moving averages. The 11 sectors of the S&P 500, I'll break those down. So you can see again the 20 on the right side, the 20, 50, 100, and 200-day moving averages. And it gets a green dot if it's above those, and it gets a red dot if it's below those. So if there are 11 sectors, there are four moving averages, that's 44 potential dots that can go in either direction. There are 5 out of 44 that are above any moving average. And those relate to two sectors, and those are, as I showed in a previous chart, consumer staples and actually energy. Energy is above 2 of them, and consumer staple above 3. All others are below their moving averages. So that's 39 out of 44 dots below moving averages. There are 5 green dots this time. Last week there were 14. So indicating it was a pretty bad week for equities. Okay, now I'm going to give you some charts that show direction. This will again be direction of various indexes in the market. This is just the pure S&P 500. It's a weekly chart. Movements are, one move is equal to a week. It's better to show a weekly chart than a daily chart because weekly will give you a little more of a macro view. The daily chart has so much noise in it that it's hard to follow sometimes. So you can see for up until the end of the year in December, so this would be about 8 months, the black line, the S&P 500 was going in an upward direction. Since about January 1, the S&P 500 has been declining. It goes up and down, but the general direction is down. Earlier I talked about the ARK-K Innovation Fund, and it's down 48% year to date. But if you go all the way back to February of last year, it's down 70%. And the reason I point this out was prior to that time, it was a hot fund. I mean, it was the hottest of hot. People were piling on to ARK-K. And when it went out of favor, it has stayed out of favor. And this is not unlike the biotech index, down a lot and doesn't show any strength at all. Not a good indicator for the market in general, in my opinion. Netflix, I just thought I'd put this in there, down 73%, Netflix, since November. So this is about 6 months. So Netflix, you're maybe familiar with the FANGs, F-A-N-G-S, Facebook, Apple, Amazon, Netflix, and Google, FANGs. That's one of the FANGs. And it was hot, just like ARK, hotter than hot, until it wasn't. And what goes up a lot tends to usually come down a lot. And Netflix is showing that. And by the way, Amazon and Google are also having their own problems. So there's a breaking down of sectors, and there's a breaking down of stocks within sectors that are significant, that sometimes when you just look at the S&P 500 or the Dow Jones, you don't see that. But inside of those are things like this. When we take the S&P 500 and break it apart into growth companies and value companies, growth are those that focus on revenue, value those that tend to focus more on profit or profitability. And those are indicated by the ETFs, SPY-G and SPY-B for growth and value. And so when you put those together in a ratio, the numerator being growth and the denominator being value, you can see it establishes a chart that shows relative to each other how they're doing. So this chart shows that during up until, it's a 12-month chart, up until November, growth was in favor. And since November, value has been in favor. As I said earlier, both are down, but value is down less. The small cap index for the Russell 2000, which is the small cap companies, is the index that covers the smallest 2,000 companies, and IWM. And so when we create a ratio between SPY, the S&P 500, and IWM, small cap Russell 2000, SPY being the numerator, Russell 2000 being denominator, you can see that it is down. And so this shows that the Russell 2000 is definitely down over that 12-month period and continuing to go down. Then I jump over to bonds. The long-term government bond, TLT, relative to nothing else, just by itself, you can see where it has gone for the last 24 months. So this is a 24-month weekly chart. And I put this in here so you can see these two long periods of decline. And if interest rates continue to rise, bonds, and TLT in particular, are going to continue to collapse. What can happen, and usually does happen, is that what happens in the middle is it goes back up. I call that a head fake. It goes up thinking, oh, I want to go back up, I want to go back up. And it does for a while until it collapses again. And that's how down markets happen. It's actually how up markets happen. So when it's in a downward trend, it'll go down, and its momentum, it surges down, and then it tries to go back up and then collapses again. And it goes through that a series of times until it finally hits the bottom, whenever that is. But I think that's the process that equities will go through, and I think it's the process that bonds are going through. The Vanguard Extended Duration Government Long Bond, EDV, is down 27% since November 29. So yes, TLT is down about 19 or 20. The extended duration is down 27. This is not a good picture for bonds. Gold, up and down a lot, but the general direction over a 24-month period is generally positive. And same with silver, SLV, up and down a lot, general direction over 24 months is positive. When I compare these two, putting silver as a numerator, gold as a denominator, you can see that for the first 10 months or so, that SLV is clearly in favor, performing better than GLD. And then for the last 14 months or so, GLD has outperformed, meaning that it's going down. So relatively speaking, gold has outperformed during the past 14 months, slightly. I mean, they're both up, but gold has outperformed. The volatility index, it's called the VIX. Volatility index measures the volatility of the market. And it is generally thought that when the volatility index is above the number 24, it's kind of I won't say it's an artificial number, but it's just a number. So when that index goes above 24, then that is, particularly if it's coming from the bottom and going up above 24, that means there is increasing volatility in the market. And you can see where I put a red mark there. So you can see this is a 6-month weekly chart. So you can see the direction that the market has gone above 24. And, you know, anytime it's above 24, it's considered probably bearish or negative for the equity markets. So I told you at the beginning I did cover some negative things. It's just it's what I discovered, so I'm going to tell it to you. But at the end I said, what I'm going to tell you is what you can do to protect yourself. So these are things I just thought of. These are, if I were going to, without knowing your individual circumstances, if I were going to give you advice, these are things I would say in general, subject to your own circumstances, perhaps would dictate something different. But in general, I would stay away from buy and hold investing. Don't buy new real estate today. There will come a time to buy it, not today. Secure your income, whatever that means to you. Do what it takes to have your income be as stable as possible, because with a coming recession, if that's what's in our future, which I believe it is, then you're going to want to have the income be as secure as possible, because there will be layoffs, and probably substantial layoffs. Watch out for your emotions. That speaks for itself. But sometimes our emotions come into play in the decisions that we make, and instead of thinking logically from our brain, our emotions get in the way, and sometimes we could make bad decisions. Don't buy what the media is selling. Their objectives are different than your objectives. Their goal is to sell advertising. And to sell advertising, they usually work on your emotions and they work on your wants, not your needs. So be careful when you watch media. Be wary of who you think you can trust. Isn't it amazing that today trust is a big deal? There are so few people who are saying so few things that you actually can take to the bank and trust. It's sad, but be wary, be skeptical of what you hear. And finally, enjoy your relationships, your family and your friends. They are valuable. Stay calm. This is just a correction, right? Thank you for watching. If you have comments or questions, leave them in the comment section below. I will answer all of them, and thank you for watching.